We were discussing about first volume profit analysis. I'm very sorry for the inconvenience for technology matter. We discussed the break-even point. We calculate break-even point, just divide by fixed cost divide by the contribution. Then we calculate the break-even point not in terms of quantity but also even rupee wise. There were two ratios, I think. Shall I show you the here? These are the two ratios: fixed cost and the unit contribution margin, and fixed cost and the unit contribution margin ratio. So we learn how to calculate the fixed cost contribution margin and contribution margin ratio. Then of course we discuss the how to prepare graph really. This is profit volume graph and this is profit chart, and we discussed really this target profit story also, fixed cost plus target profit and unit contribution margin. Then we discussed the margin of safety. So I think we stop at multiple changes in key variables stage. Yes. They are moving involves increasing unit price, increasing selling price, undertaking a new advertising campaign, leasing a new office, an incremental approach to analysis, focus on differences in total contribution margin, fixed cost and profit under two alternatives. There what we are going to do is here, we will change, different variables. So I think I can remember in my example, we took, anyway, we will, last time I think I had an Excel sheet. I just wanted to share with you, but anyway, increase in unit price, increase in selling price, undertaking a new advertising campaign and leasing new office. So what we are doing is here we are trying to change the different variables in the sense selling price, selling unit, maybe additional fixed cost, maybe variable cost, likewise. So when those figures change, what will happen to the break-even point? That kind of stuff we are going to discuss there. Then Cvp analysis with multiple products, sales mix, relative proportion of each type of product sold by the generation, weighted average unit contribution margin, fixed cost divided by weighted average unit contribution, break-even. Now here what we are going to do is, now earlier we talk about only what you call single product. Now here we are discussing not a single product. Here we are discussing multiple product. That means more than one product. That's why it's mean sales mix. So with regard to this one, we need to identify the fixed cost, which is common, but we are calculating weighted average unit contribution margin. So weighted average contribution margin you have to calculate, and it divided by the fixed cost divided by the particular things. So this is basically the activity based, some other different concepts, identifying activity level cost. I don't think here it's relevant for you. Then including income tax in Cvp analysis, what happened is fixed cost, when there is a target net profit after tax, what you have to do is you have to convert it to before tax. That's why divide by 1 minus t. Then everything divide by unit contribution margin, then you get the break even if there is a tax element, if the target profit is given after tax. Then the assumptions underlying CVP analysis, of course, the behavior of total revenue is linear. We assume that revenue is linear. We assume behavior total cost is linear over a relevant period. Cost can be categorized as fixed and variable. Labor productivity, production, technology, and market conditions do not change. There are no capacity change during the period under considerations. So both fixed and variable fixed cost, sales volume only cost driver, sales mix remain cost over the relevant range if you are calculating break even for the sales mix. Then manufacturing firms and the level of inventory beginning and end of the periods are same. So that is about the what you call assumptions. So what I will do is I will discuss these assumptions with reference to the chart what we do. So when you look at this chart, we draw this chart. This is called revenue. So this is you see linear. Linear means the slope of the curve is constant. Now when you calculate the slope of the curve here, that is constant. So how do you calculate the slope? Slope is basically this part, so this segment divided by this segment, then you get the slope. So thereby you will see slope is always equal to 21 rupees, which is your price. So price multiplied by the number of tickets, you got the revenue. Here if you are selling 0 tickets, your income is 0. But here if you are selling 2,000 tickets, your income would be 2,000 into $21 here in this case. If you are selling 4,000 tickets, your income would be 21 into 4,000 tickets. Likewise, if you are selling 10,000 tickets, your income would be 10,000 into 21. That is the logic. So that's the one assumption. One assumption is that whatever the quantity, you can sell at a fixed price. If the price is 20, you can sell 2,000 tickets at 20, 4,000 tickets at 21, even 8,000 tickets at 21, even 10,000 at 21 rupees. So the price is constant in this model. That is a one assumption. And one assumption is selling price per unit is constant. So thereby your TR revenue, total revenue curve is linear. Second one is unit variable cost remain constant. So thereby your cost curve also linear. Now, for example, if you divide this by 0, you get the fixed cost, and any point you select here, if you do it, if you divide it by the quantity, you get the unit what you call unit variable cost. So thereby in the cost volume profit analysis, unit variable cost is constant. So thereby your curve, total cost curve, even very linear. That is the number 2 assumptions. Number 3 is that whatever the cost incurred in your business organization, we are trying to categorize into 2 parts. That is fixed cost and variable cost. There are no other category, only fixed cost and the variable cost. So this is applicable only for a particular, relevant range. So they are beyond relevant range, these cost behaviors not really line with what we said, fixed selling price and the fixed unit variable cost. Then other assumption what we discuss is if you are selling more than one product, we assume that product mix or the combination of product, the weightage of product mix is not changing. Those are the assumptions what we really focus under CVP analysis. Coming back to assumption again, here cost can be categorized as fixed and variable. Revenue is linear, cost is linear, and labor productivity and production technology and market condition do not change. So we assume that, you know, that in environment, when you do the business, certain factors change. You know, labor productivity increase, decrease, production technology you may advance, or you may you know, remove certain technologies. Market conditions, nature of the competition, nature of the customers, so their expectations, competitors' strategies, all these you know, change. But when you do this assumption, since the short-term period, we assume that all the other factors, all environmental related factors, both internal and external, maybe market related, maybe economic related, maybe technology related, maybe labor related, maybe other resources related, whatever the environment factors, we assume not change. Then there is no capacity change also. When a capacity change, you know that economies of scale is coming now, thereby production cost is reduced. So thereby we assume that there is no capacity change as well. And finally, the both fixed variable cost volume is only the cost driver. For the profit, there are only three factors influencing for the profit: variable cost, fixed cost, sales volume. Those are the three factors influence on profit. Then the sales mix remain constant. That's what I explained. CVP analysis in the longer term, CVP analysis is usually regarded as short-term tactical decision tool. Classification cost as variable and fixed is usually based on cost behavior over the short run. So fixed costs, short-term classification, fixed and variable. Financing impact on long-term decision is best analyzed using capital budgeting techniques. So this technique is applicable only for short-term, maybe short-term pricing decision, maybe short-term capacity decisions, maybe short-term planning. Next month sales volume, how you are going to plan. Next month sales or the business operation, how you are going to plan. That's kind of short-term decision. But if you want to go for longer-term decision, as we discussed in the capital budgeting last week, capital budgeting techniques, NPV, IRR, profitability index, time value of money will be applicable. But when you do this, what do you call CVP analysis, you have to use very carefully. It's a very simplified model, very simple model, because we are in a dynamic environment. In this dynamic environment, we only assume that all other variables constant, selling price, unit cost, and the sales volumes are only important. So other all factors remain constant. That's why it's a simplified model. The useful, so thereby it's in a dynamic business environment, application of CVP analysis is really criticized by many academics. The useful CVP analysis may be greater in less complex, smaller firms and stand-alone projects. You know, usefulness of the analysis, as I told you, when environment is you know, much more dynamic, see, this simple model is not applicable. But if the firm is much more simple, or I would say here less complex, small, less complex, and standalone projects will be for that kind of project, CVP analysis would be applicable. For example, suppose you are organizing you know, a film festival, you are organizing a musical show. I think those kind of stuffs, very standalone projects, small firms, where complex matters are not important, where the interaction with the outside environment is not that much open, your business is much more close, then this CVP analysis is useful. For large firms, CVP analysis can be valuable as decision tool for planning stage of new projects and when Even for large firms, when you are doing the planning, what will happen, what is the next sales, next month sales target, what is the next 3 months, 6 months, likewise. So for planning stage, of course, this will be useful. Then the activity-based approach to CVP analysis, of course, activity-based categories cannot be discussed under this because you have to cover that title, but I didn't cover up activity-based costing here. So thereby I will leave it that particular slide. To discuss this, of course, you should know the activity-based costing. So there are activity-based costing is a new costing technique which emerged just because of Japanese management technique. There you talk about batch cost and etc. Limitation of assumptions is total batch level cost are dependent on batch size and management may change. This is limitation of this activity-based costing again. Then we come to the financial planning model, sensitivity analysis. You can do and can use the spread Excel sheet and goal seek approach and what if analysis. So financial model, planning models, this CVP analysis is applicable. So that's about the what do you call this CVP analysis. Then we can talk about the other one, but is the financial performance measurement for investment center and reward system. It's a new topic. Now we have covered basically 4 areas: time value of money, cost of capital, capital budgeting, and CVP analysis. CVP analysis is not a big thing. It's just dividing fixed cost by unit contribution. We discussed how to calculate the fixed cost last week, and unit variable cost and contribution, etc. Okay, we will come to the financial performance measures for investment center and the reward system. It's about we are not discussing here. We will discuss corporate level organization structure, not a simple structure where you have group financial group business model. Under one business, under one group, there are so many businesses. So that kind of structure we are discussing under financial performance measures for investment center reward system. Even your bank, if your bank is the parent company, your bank may have subsidiaries related to your financial banking and industry banking business, maybe finance company, maybe IT related company, maybe another service oriented business, some related businesses you may have. So outline the lecture: financial measures in investment centers, return on investment, residual income, measuring profit and invested capital, measures shareholder value, reward system, theories of motivation, performance related reward system. These are the areas what you are going to discuss under this title or the topic or the session. Okay, financial measures in investment centers. Basically, when you look at any business organization, CEO level, that is we call strategic business unit or divisional units, focus on summary of profit-based measures used to evaluate the performance of profit center and the investment center. Idea is this: when you have the simple organization, what you can do is the owner, entrepreneur, the sole proprietor does the everything. When you expand your business into other areas, the single man or the single person or single mechanism cannot perform all the activities related to your group of business. So thereby you are allocating certain business among experts, maybe one person to look after the banking sector, another person to look after the finance sector, the what you call leasing and finance sector, another person to look after the IT business, another person to look after the entertainment business. So what you do is when you expand the business, you decentralize, you distribute the power to the down rather than keeping power with you. That's called decentralization, not the centralization. So in a decentralization business environment, when you give power to the down, as board of directors, you may lose. As top management, you may lose the controlling power of your employees because you have given the power to the down. You have distributed, you have given your power to the down. So thereby, inability to control. This concept is called empowering. You empower people. You make people more freedom. We call it autonomy. You are giving autonomy to the people. Then only they can perform their business very attractive way. In such situations, what you do is one way of controlling, one way of disciplining your employee, one way of I would say docile or train to behave the way you want is done by really responsibility centers. These responsibility centers are called profit centers and investment centers. Profit center means manager, maybe even branch manager, maybe regional manager, maybe a CEO of a particular business unit. The profit center means if that branch or the regional manager's work or the particular SBU, strategic business unit, if it is a profit center, that manager, that CEO is responsible for both revenue and cost. That is the meaning of profit center. Profit center managers are responsible for both cost and revenue. Thereby, they have to manage the cost, they have to run the business in an efficient way, all unnecessary activities, managing resources, addressing the inefficiency issues are responsibility of those managers. That is one side. Eliminating unnecessary overheads, cost-cutting programs, cost control programs are the responsibility of profit center managers. And also they are responsible for the revenue income. So thereby they will take the pricing decision of the product. They will look after the customers. They will have the very good relationship. He or she is responsible to maintain good customer relationship with customers. That is profit center. So thereby, those managers' target is to increase the profit if it is a profit center. So they are responsible. If it is a profit center, normally top management is giving profit-based targets for those managers. So investment center is a little bit different concept. Investment center is more empowering, more empowered center than the profit center. Investment center is a more empowered. That means investment center, of course, profit center plus investment decision-making ability. So thereby, if your center, if you are working as an investment center manager, maybe in your branch, maybe as a regional center, maybe as a CEO of a particular unit. If you run as an investment center, meaning is that you are responsible for three things. You are responsible for cost, you are responsible for profit, you are responsible for revenue, and you are responsible for investment. So efficiency issues you should be addressed. Effectiveness, that is the generating revenue, setting price, discussing with customers, quality matters of your product or service, all these are responsibility of yours. In addition to that, those are the characteristic of profit center. So investment center is the characteristic of profit center, plus those managers have the autonomy, the right to take investment decision. No need to go and ask from the top management. So thereby they are taking the investment decision as well. But profit center managers, they cannot take investment decisions. For investment decisions, for new projects, they have to get it approved from their top level. But investment center managers, they can really take their own investment decision. But in certain investment centers, top management may limit the investment amount. They may be okay, you can take whatever the investment up to 10 billion. About 10 billion, you have to get our approval. So there may be such investment centers also, depending on the case. But the meaning of investment center, you are responsible for revenue, you are responsible for cost, you are responsible for investments. Those are the three areas. We call it investment. We call it investment centers. When you have this kind of performance measurement, that is responsibility center based performance centers. This is you are accountable for profit. Here you are accountable for profit and the investment both. Accountability has been established in terms of creating profit centers and investment centers. So there are three types of measurements here. One is the return on investment, ROI concept. We learn ROI. Other one is residual income, RI. Third one is economic value added. These are the three areas of measurements under our title. Okay. How do you calculate return on investment? Is basically return on investment is profit divided by invested capital. That is the return on investment, used to measure the performance of an investment. So return on investment, when you say profit, it has I would say profit invested capital has two elements. One is the profitability. Profitability is profit divided by sales revenue. This is called profitability ratio. How do you calculate it? Profit divided by sales revenue. This reflects the profitability, or I would say effectiveness of your business. It measures your effectiveness, the profit divided by sales revenue. Okay. On the other hand, there is another ratio, sales revenue divided by invested capital. This shows the efficiency of your business. Efficiency. Sales revenue divided by invested capital. It measures the efficiency. So thereby, you see that here sales and sales, two figures are, mathematically can remove. So thereby, what is remaining is profit divided by invested capital. That's the base of the formula. When this is and this is the cutoff, so you will get the profit divided by investment. On the other hand, return on sales, investment turnover, this particular ratio is labeled as return on sales. Another name is profitability. This is investment turnover, that is the efficiency. So thereby, ROI is a function of return on sales and investment turnover. You got the point? When you define the ROI, ROI is the function of return on sales into investment turnover. That is efficiency and effectiveness. This measures the effectiveness and this measures the efficiency. It reflects, your ROI will reflect return on sales and the investment turnover. Then the investor capital, the assets that the investment center has available to generate profit. Return on sales, the percentage of each sales dollar that remains as a profit after all expenses are covered. That means profit after tax divided by sales. And investment turnover, number of sales dollars or the rupees generated by every dollar of invested capital. So that is the investment turnover. Invested capital, return on sales, and investment turnover. Those are the technical words, definitions, what we can use. Return on investment, improving ROI means increase return on sales. So you are trying to, when you say you have improved your ROI, increase return on sales. By increasing the selling price or sales revenue, or decreasing the expenses, what you can do is you can increase the selling price and you can increase sales revenue, but you can't increase the expenses. You have to decrease the expenses, decreasing expenses. Then increasing investment turnover. When you increase the efficiency, of course you can increase the ROI. So there are two methods, basically, two approaches to increase the ROI. One is you increase the return on sales. That is the first one here in this formula. You increase this one and also you increase this one. That's the two approaches. Increasing investment turnover by increasing sales revenue and reducing the invested capital. Actions that are taken with those purpose of making these ratios more favorable in short term may have adverse effect on performance in future years. This is, this performance measurement more favorable in short run. It is true, but when you look at it, future years, adverse effect. So I will take one or two examples to explain this. Now suppose you are being evaluated based on ROI. Your branch is evaluated. Your branch performance measurement is ROI of your branch. Top manager is always looking at your ROI. Then what you will do? You know that you are being governed by ROI. So thereby your target is always to improve ROI. If you can't really improve, then you tend to manipulate. If your bonus, if your allowances, if your additional salary, if your reward is based on ROI, what to do? You anyhow will increase ROI. Even though there is no return on investment that much percentage, you may negotiate, you may have a network with your accounting people and relevant parties to manipulate the ROI. You may advise for your accounting people as CEO, powerful man in your business, you may advise, okay, please postpone the expenses to the next year. Especially if it is December accounting period or March accounting period, you may ask your accountant to don't put all the expenses which is incurred in December. Try to defer. By December January if it is March, you are counting here. If it is March, deferred. When you defer expenses, you are decreasing the expenses. You can manipulate the ROI. On the other hand, when you finalize the financial account, you may tend to take, future income. For example, suppose you are preparing the financial statement for March, then you might ask the accountant, okay, why don't you take some invoices in April to March? So you may really increase sales by taking next month sales to this month. So thereby what happened is your sales revenue will increase. On the other hand, how you can increase the investment turnover? When you try to increase sales, of course, then what you have to do is the increase investment turnover. You may overvalue your investment to get it a higher number. Anyway, so likely there is a possibility of manipulating ROI. Suppose as CEO or the branch manager, next year you are going to leave. You are going to leave the organization and join with another one. What you will do this year? Or suppose your target is to leave the organization within next 2 years or within this year. Then of course, if your performance measurement is based on ROI, you manipulate. Manipulate karla, overstate karla, bonus ticket aragena, you will leave the organization. Who pays the problem? When new CEO comes, he realized this situation. What is the earlier CEO has done? So thereby measuring performance based on ROI, return on investment, is little bit questionable, even though it has advantages. The advantages of ROI very widely used to measure the performance. It's a popular technique, ROI, return on investment. Whatever the annual reports you look at, ROI concept is there in your annual reports. It's a familiar, famous, widely used concept. Encourage managers to focus on profit and assets required to generate those profits. So always your mindset, your vocabulary, your discipline is profit. You are being disciplined to get a good profit. So thereby you are being disciplined to get required assets to generate the profit also. So thereby, so you are playing with this particular terminology. That is how you have been disciplined if ROI is there. Promote and understand the relationship between revenue, cost, and assets. Can be used to evaluate relative performance of investment center even with those business units are different size. Because ROI is a percentage, so thereby you may run the financing or banking business, but you can compare your performance with the other maybe entertainment business CEO. So thereby, So evaluating relative performance of the investment center, again, CEOs, different CEOs can compare their performance or his or her performance with the other colleagues' performance in the same group. Okay, that's the another advantage of ROI. So what are the is used? Simple, widely used, encourage profit focus, and it can compare. It's a relative measurements, thereby you can compare performance with other investment centers. Then the limitation of ROI, of course, encourage managers to focus on short-term financial performance at the expense of long-term viability of competitiveness. So the profit is a short-term measurement. Profit is not a longer-term measurement. It's short-term measurements. So thereby, when you manage this business, if you measure the performance based on profit, that is ROI, your focus is not the long run. Your longer term validity and competitiveness is ignored. You sacrifice the longer term validity and competitiveness. That's why it says at the expense of long term validity and competitiveness. So thereby, in that sense, ROI is not a good indicator. Encourage performance to short-term financial performance. Second one, encourage managers to defer assets replacement. When there are feasible projects based on NPV, according to the NPV, project has to be accepted. But according to ROI, project is not feasible. Then what you will do? If you are being evaluated ROI, any projects you are not going to accept if it has or if those projects are having a negative impact on your current ROI. So thereby what happened? මොනවාරි කිය CEO කරන්නේ ආයතනයේ තියෙන හොඳ projects කල් දානවා. ඒකට හේතුව තමයි මේ project එකෙන් එයා බලාපොරොත්තු වෙන ROI එක එන්නේ. ඒ project එක time value of money feasible වුණා. Encourage managers to defer assets replacement. ඒකට හේතුව තමයි assets replace කරගාම වෙන්නේ මොකද අලුත් වත්කම් වෙනවා අලුත් වර්ණාකම් වෙනවා. ඒතර profit එක එහෙමමයි. Profit එක බෙදන්නේ අලුත් අගය වැඩි අගයන්ගේ. එතකොට අපිට පේනවා ඇති ROI එක වැඩි. ROI එක අඩුයි. ROI එක ගිය පාට වඩා මේ පාර අඩු වුණොත් මැනේජර්ට ලොකු ප්‍රශ්නයක්. Suppose last year ROI of as a CEO my ROI was 16%. Next year my ROI is 10%. So what is the situation? In relation to the last year 16%, this year 10%, so management, top management will decide, okay, your performance is bad. We are not offering you a very attractive salary package this time. No salary increment because last year it was 16, now this year 10%, your performance is not acceptable. Something like that. Then encourage managers to defer assets, discourage managers from investing in projects which are acceptable from organization point of view, but decrease in investment center ROI. So whatever the project, if it is decrease the ROI of the investment center, here, ROI of the investment center, if I am the CEO, I am not going to accept because if you accept that project, what happen is your ROI is reducing. It's not good thing for you. So thereby, even though project is feasible, financial wise, based on NPV calculation, even if it is feasible, my organization politic is to reject the project because ROI is not good that project. So thereby goal congruence is a action. Okay, difficult to ensure the goal congruence because of ROI. What is goal congruence? Goal congruence means when there are many businesses in your organizations, many CEOs under one umbrella, all divisions, all the groups the companies which are coming under the groups, all the businesses should direct to one direction. That's called goal congruence. If as managers, as CEO, if our directions are not towards the strategic direction of the group, then goal congruence is not there. Goal congruence is moving towards one direction. All the sub-companies are moving direct to a one direction. Minimizing the behavioral problem of ROI. What is the behavioral problem? Behavioral problem is CEOs are not really acting according to the rationality, benefits of the organization. CEOs are not acting for the benefits of the organization. They just consider their rewards. So thereby there is a tendency of rejecting good projects. So what we can do is use ROI as one of several performance measures that focusing on both short-term and long-term. Consider alternative ways of measuring invested capital to minimize dysfunctional decisions. Use alternative financial measures such as residual income and economic value. First one is use ROI as one several performance measurements. The focus on both. Don't focus only on ROI. You include some other measurements. Maybe payback method, maybe cash flow ratios. Not only the ROI, you bring some other measurements. So then you will be able to focus on short-term as well as long-term performance. Consider alternative ways of measuring invested capital to minimize dysfunctional decisions. Third one is use alternative financial measures. So instead of ROI, you use alternative method, that is RI, residual income, and economic value added, EVA. What is residual income? Residual income is basically profit minus, use here, invested capital into imputed interest rate. Imputed interest rate means cost of capital, benchmark rate, maybe interest rate, maybe discount rate. So what you do is invested capital. If you invested 100 rupees, if your imputed interest rate is 2%, you apply the 100 rupees into 2%, you find out the minus it from the profit, you find out the residual income. That is the residual income calculation. Imputed interest charge based on the required rate of return that the firm expects of investment, which is based on organization cost of capital. Imputed interest charge is, as I told you, maybe weighted average cost of capital. Weighted average cost of capital is the weighted average of the cost of funds from all sources of borrowing and equity. I think I have discussed with this you. The advantage of residual income, more likely to promote goal congruence and compared to ROI. I explain you what is the meaning of goal congruence. What is the goal congruence? Goal congruence means when there are more businesses, what you do is you all groups work according to one direction. That's goal congruence. Like in your family, if there are 5 members, if the 5 members are really behaving in a different way, it's very difficult to maintain the family direction. All the members in family should move one direction. That is the role of the fathers and mother, especially when you are young. So I think they may influence you. They really you really depend on them. So thereby they control you. By controlling them, what they did was they put all the members in the family in one direction. That's called goal congruence. Likewise, when you have a group of companies, board of directors should control all other CEOs, because CEOs really, we have been we have really given more autonomy for the CEOs. So thereby its controlling requirement is required. That's called goal congruence. Take accounts of organization, require rate of return measuring performance, encourage investment in projects which yield positive residual income to the organization. So thereby goal congruence, it takes into the cost of capital of the organization. That's the required rate of return. You can remember the name, required rate of return, cost of capital. It considers the cost of capital when measuring performance. It considers the goal congruence, and also encourage investment in project with yield positive residual income to generate organization. Those are the advantages. The disadvantage of those things we will be discussing. Cannot be used to assess the relative performance of business that are different size and unlike ROI. This is the problem here in the what do you call residual income. You see, residual income is not a relative measurement. මෙතන profit එක 100ක් වුණා නම් මේකෙන් එන අගය දාලා අඩු කරලා එන්නේ. එතකොට ඒකට කියනවා relative measurements, absolute measurement කියලා. But you see, ROI is a relative measurement. ROI is a relative measurement. Profit divided by invested capital multiplied by 100. It's a relative investment. Even though it's not multiplied by 100, you get a decimal figure. When there is a decimal figure, you know it's the figure you calculated based on one particular base or the relative. So thereby ROI is a relative measurement. RI is not a relative measurement. It's an absolute measurement. So thereby what happened is disadvantage. RI does not show the size, cannot be used to assess relative performance of this and that are different sizes, unlike ROI. When you compare the ROI, that matter is not there. Since RI is a relative measurement, it's very difficult for you to compare. Formula is based on favor of larger business, unlike, so this is applicable for large organization because cost of capital is required. Without cost of capital, you can't calculate the RI. So thereby application of RI is little bit narrow when compared with the ROI. Can encourage short-term orientation focus, as that is also short-term focus because profit is short-term. Since profit is short-term, RI also short-term, like ROI. Measuring profit and invested capital here. Measuring profit and invested capital. How to measure the invested capital? You take the total assets. Investment center manager is responsible for decision all the assets. Total productive assets. Investment center managers retain non-productive assets. Total assets less current liabilities. Investment center responsible decisions about assets. Manager short-term liability. Choose average year-end balance. Average or year-end balance. Now here, when you calculate the ROI, profit, the invested capital is much more important. So what would be the value of the invested capital? That's the question. If you are running a branch, are we going to take the value of the building which is looked after by head office as invested capital. So thereby, when you take assets for calculating invested capital or the total assets, take whatever the assets manager is responsible. Assets which are not responsible by manager cannot be considered as invested capital. Invested capital. Suppose you are in a branch machines purchased by yourself, investment decision. All the machine purchase, the final approval is from you, not from the head office. So thereby, whatever the machine in your office are responsible, or the machines are controllable to you. That is, machine is a result of all the machines, results of your decision, not from the head office. On the other hand, say there is a specific machine which is very highly valued. So that machine purchased, or the decision taken to purchase from the head office. So thereby, what I want to communicate to you is that specific machine in your branch is the results of head office team's decision, not your decision. So thereby, it is not your responsibility. You can't include as invested capital from the branch. That's the idea. You take always controllable investment. You don't take uncontrollable investment. Total productivity assets. Investment center managers retain non-productive assets. You take only the productive assets. Remove non-productive assets. You have to remove the non-productive assets, but take only the productive assets. The current liability is also reduced from the total assets, and you can use the average and also end year if preferred. Assets measurement. Advantage of carrying amount: consistency with balance sheet prepared for external reporting purposes. Consist with the definition of profit. Asset measurements, when you carry out the assets at carrying amount, so you reduce the depreciation, so thereby it's a plus point. Advantages of acquisition cost. Choice depreciation method is arbitrary. Resulting carrying amount does not provide a reliable measure. Depreciation non-current assets may provide a disinvestive to investment and gain. So thereby, these are the advantages and disadvantages of assets measurement. Just look at this one. Can you understand this table? Just look at the table. Now you see profit before depreciation, year 1, year 2, year 3, year 4, 150, 150. Accumulated depreciation, that is annual depreciation, 100,000, 100,000, 100,000. Profit after depreciation, 50, because this minus this, you get 50. Average carrying amount is this much, and the profit is so much. Ratio, acquisition cost is so much, based on that is 10. So I think so if you, I think you can't, it's difficult for you to so shall I explain it, how to calculate it? Acquisition cost is 500,000. When you 5 years, therefore this divide by 500, that is the depreciation. You are acquiring 500,000 worth of equipment today. If you use it 5 years, at the end of the 5 year, salvage value is 0. If the salvage value is 0 at the end of the 5 year, each year cost would be 100. First year depreciation, second year depreciation, third year depreciation, fourth year depreciation, fifth year depreciation, 100,000. Right? Profit figure assume 1,550, deducting depreciation before. Here it's taken 150 minus 100, 50 profit after depreciation. I think you can understand this one. Then average carrying amount is calculated this way. Average is calculated by taking year beginning value and year end value. If you take the first year, what is the beginning value of this machine equipment? You have to remember it is 500. Here, beginning value is 500. At the end of the year, since you use the equipment 1 year, value is not 100. You have to minus the depreciation, thereby 400. So beginning of the year is 500, end of the year is 400. Average investment is 500 plus 400 divided by 2, 450. Is it clear? Similarly, how do you calculate here? Average investment. What is the second year beginning value? Second year beginning value is 400,000. First year end means second year. So you take the 400. And what is the second year end value? Second year end value is after 2 years. So 500 is the beginning. After 2 years, you have to reduce 200,000 because first year depreciation and second year depreciation. Thereby, second year closing balance would be 300. එතකොට 400යි 300යි you add 400 and 300 altogether 700. 700 divided by 2, 350. Are you clear? So how do you get this 50,000? For example, this 50,000 is the fourth year. Fourth year end balance and fourth year beginning balance you have to take and tell me what is the fourth year beginning balance. Fourth year beginning balance means you have used the assets. Fifth year beginning balance. Fifth year beginning balance, you have used the assets 4 years, year 1, year 2, year 3, year 4. Thereby, total depreciation would be for the first 4 years 400. 400 rolling 500 rolling 400 adu karama apata enawa 100 siya. That is the beginning of fifth year balance. And you know what is the end balance of the fifth year? End balance of the fifth year? 0. අවුරුදු පාවසානේ 100 ගෙවිලා අවසන් වෙනකොට salvage value is 0. So thereby, what is your average? Average එක තමයි 100 ධන බිඳුව බෙදීම 2. 100,000 plus 0 divided by 2, that is 50. Then how do you calculate the ROI based on carrying amount? Profit divided by 450. මේ 50 මේ 450 බෙදනවා 111. This 50 divided by 350, 14.3. This 50 divided by this 20. This 50 divided by this 150, and this 50 divided by this 50, 100%. So you will see the ROI based on carrying amount. The average carrying amount is, increasing. The assets පරණ වෙන්න මොකද වෙන්නේ? Assets පරණ වෙන්න your ROI will get increased because of depreciation issue. But on the other hand, the acquisition cost is 500. So if you calculate the ROI based on acquisition cost, 50 divided by 500, that is 10%. So it is constant. So you can calculate the ROI in two ways, either to base on carrying amount, the average, or either to calculate based on acquisition cost. It depends on your organization. So thereby, when you try to interpret this ROI, you see first year ROI is 11%, 10%. First, second year ROI, third year ROI 33%, 10%. So if you are a CEO, which measurements you will like to adopt? You discourage this. මුලා අවුරුද්දේදී you are indifference. ඔකට කොයි ක්‍රමයකට ගණනය කරත් වැඩක් නැහැ. දැන් CEO පරණ වෙන මොකද කරන්නේ? CEO will move towards this way and he will be calculating the ROI based on carrying amount. Just to manipulate the figures. He'll say, fourth year very good. But compared to last 3 years, this year ROI is 33%. Excellent. But behind that, there is a calculative practice. There is a statistical logic. If you are not understanding this statistical logic, so your decisions, your final decisions are not appropriate. Is it clear? So you have to be careful when analyzing percentages, when talking about percentages. Percentages are much more important. Even this COVID situation, even election situations, you may calculate different percentages. What is important is how you have calculated these percentages, calculative practices. You have to understand those things. Otherwise, interpretation is not effective. I think I explained that measuring profit margin contributed by investment center managers, suitable when focus is performance of the manager. Encourage managers to focus on profit that can control, motivational impact, profit margin attributable to investment center, calculate investment center. Now, when you try to measure the profit, now here we discuss assets measurement. Asset money known. Asset either to measure at carrying value average or acquisition cost. Now the other issue is, now we have discussed how to measure this this particular invested capital. Our target was that. That's what we learned from that table. Now we are going to do how to measure the profit. How to measure the profit is the point now what we are going to discuss. How to measure the profit. Profit margin should be always controllable by the investment center managers. You take the controllable profit. So thereby you take the controllable income, controllable expenses. Uncontrollable expenses cannot be put under the investment center manager. Uncontrollable investment. Uncontrollable expenses. For example, suppose your branch, you have the salary. Of course, employees are controllable to you. So thereby salary cost is controllable to you. But on the other hand, salaries is determined by the head office. Then salary expenses are not controllable to you. Because it's not a result of your decision. If salaries depend on your decision, you are giving the incentives, you are rewarding them, you decide how much to pay. Of course, then that salary would be really controllable. In certain cases, in certain businesses, salary may has two components. One is decided by a fixed salary for the employees, maybe monthly. All employees in your branch, the particular category, executive category, okay, they will get 50,000. That's the norm. But depending on the performance, monthly bonus, monthly rewards, you decide based on your target. So thereby, what is controllable is not the 50,000. Controllable, what is controllable is the employees who are getting more than 50,000 to you. So thereby, salary expenses, when you take controllable one, you take that one, not the total salary. So I hope you got the meaning of controllable. Now suppose the building in your branch, the rent is not, the rent agreement is not signed by you. Rent agreement is signed by the head office. They took the decision. They negotiate with the rent value with the supplier. If that is the case, rent expenses is not controllable to you because it's beyond your responsibility. On the other hand, you search the building, you negotiate with the building owner. In that case, rent expense is controllable to you. So what I want to communicate to you is that always we take controllable expenses, controllable income. Suitable when focus performance manager encourage managers to focus on profit that they can control. Motivation impact. That's the motivational impact. Profit margin attributable to investment center calculate as this way. Okay, look at this. Sales revenue. Then we take variable. Variable expenses, of course, controllable to you. If you are running a business, variable expenses controllable to you. For example, if you are running a small business, bakery, the variable cost incurred in your bakery controllable to you. Variable cost is always just because of operational decision. So thereby variable cost is controllable. So then sales revenue minus variable expenses, you get divisional contribution margin. Contribution, divisional contribution margin. Then you can deduct fixed expenses controllable by investment center manager. These are the fixed expenses in your branch which is controllable to you. Then you get the profit margin controllable by investment center manager. Then fixed expenses attributable to investment center but controllable by others. You are manager there, but there are certain expenses which is beyond your control, like rent. So then that 1,200 you can deduct, but that is called profit margin attributable to investment center. Then there are, of course, common fixed costs coming from the head office, because head office provides certain services to the branches. So thereby head office overheads are allocated among branches. Your portion is 400,000, which is again beyond your control. When you deduct this one, of course, you get the investment center profit before tax. Then investment allocated from investment expenses allocate interest expenses interest expenses allocated from head office headquarters. Deduct karna, you get the investment center profit before tax. Then you deduct the tax. Then you get the investment center profit. Yes, sir. Now remember, there are different profit figures. One is this one, this profit figure, 5,200,000, which is called divisional profit contribution margin. There is another profit, number 2, profit margin controllable by investment center manager. Number 3, profit margin attributable to investment center. Number 4, investment center profit before interest and tax. Number 5, investment center profit before tax. Number 6, investment center profit. So my question is, if I am going to evaluate the branch manager as the investment center, if I am going to evaluate the branch manager as the profit center, which profit is suitable? Number 1, number 2, number 3, number 4, number 5, number 6. So you see whether what are the controllable and controllable income and controllable expenses. I think number 2 is the controllable profit for the manager. If you are evaluating the branch manager, you take this 3.6 million as the profit. But if you are going to evaluate the branch, not the manager, you can evaluate the branch as well as the manager. If you are evaluating the manager, you take the profit number 2, but if you are evaluating the branch itself, I think what is appropriate is profit margin attributable to investment center, profit margin attributable to your branch. This is number 3. But these are not applicable to measure the branch performance or the management performance, these things, but they may use, headquarters may use these measurements for different purposes. So what I want to communicate to you is that when you are measuring performance by profit, you have to take the relevant profit for the manager, relevant profit for the center or the branch or the business or the business unit or divisional unit. So you have to be careful. The meaning of evaluating manager is a one person, or evaluating the total branch, total organization, two different concepts. Okay, measure of shareholder value. Then other concept is how to measure the shareholder value, because when you manage a business organization, your target is to increase the shareholder value, improving the worth of business from the shareholder's perspective. You are looking at not from the branch manager perspective, not from the branch perspective. You are looking at from the shareholder perspective. When you are trying to measure the performance, you get the shareholder value. Value-based measurement using the scholar shareholder value analysis to manage business, a framework for making business decisions that add economic value to the business, and consists of 4 aspects: valuation, strategy, finance, and corporate governance. Also, valuation, shareholder value depends on different aspects. The corporate governance, corporate governance is the total approach to manage your business. Your values, ethics, top management, controls, all these coming under the corporate governance, board structure, board compositions, corporate governance. The finance, how you finance debt, equity. Are you balancing? Are you managing? Are you striking the balance between debt and equity? And strategy, what are the strategy you focus? All these contribute to shareholder value. Most measure shareholder value. Discounted cash flow are usually used to measure the shareholder. You know the discounted cash flow method. Discounted cash flow method means you predict the future cash flows and discount by the relevant cost of capital factor. Future cash flows of the business are discounting, taking into account risk associated with those cash flows. That's the meaning of discounted cash flow. Value drivers are the activities of action that create value of business, include spread, growth, sustainability, cost of capital. Those are the factors. Measure shareholder value strategy has substantial continuing impact on the value of the business, whether you are focusing on penetration strategy, market development strategy, cost leader strategy, differentiation strategy. There are different kind of strategy. Depending on if you are focusing on one product, you may think about the penetration strategy. Penetration strategy means you are trying to focus on the current product and expand this product, more usage, more demand. You are trying to create more demand. Penetration strategy. Or you may develop, you may introduce the same product to different market, new market, the market development. Diversification. Likewise, you may have different strategies. Financial policies will influence the valuation, debt equity, corporate governance, selecting implementing system that contribute to that. So thereby what I want to communicate to you is that, of course, shareholder value influenced by four factors. One is valuation, that's what it here says. Other one is strategy, finance, corporate. The valuation, of course, discounted cash flow technique story is coming for valuation. For the strategy, the strategy what we are adopting, finance, debt equity, this thing, the corporate governance as well. When you're trying to do the measure shareholder value, the technique is economic value added. We use the economic value added. Measure the value created over single accounting period, spread between return generated by the business activities and cost of capital. This is the economic value added. How do you calculate the economic value added? Net profit after profit, that is profit, capital employed, weighted average cost of capital. So what is the difference between RI? I think you can remember the RI, residual income. What is the difference? There is no any difference. Both measurements are same. RI and ROI are same. Only difference is this R. The simple R gadaldi. Trademark, patent right, American academic group. This they introduced this, so they got the patent. So that's why EVA is like this. But RI is not such a patent measurement. Weighted cost capital, use the calculation of EVA or RI. Both are same. Only difference is patent. Here patent. Formula calculate karna krame. To improve EVA, improve the profitability without employing additional capital. Borrow additional funds when profit earns are more than cost of borrowing. Pay off debt by selling assets. That is how you improve the EVA, economic value added. You have to improve the profitability. You may use the borrowing strategy also. Then you may sell assets and unproductive assets, and you may settle the debt. Limitation of EVA. Potential for manipulation and short-term orientation. Potential for manipulation and short-term orientation. There is a possibility of manipulation. Then shareholder value added concept, another concept. This is shareholder value, but here we talk about not the EVA, we talk about SVA, shareholder value. Corporate value minus market value of debt is called shareholder value. You take the corporate value, then you take the market value of debt. Corporate value is the present value of the future cash flows. Residual value is value of the firm at the end of the forecasted period. Then we can talk about other theories, rewarding. we will have a small break, no? Yes, the time is 3:18. Shall we come back 3:30? We were discussing about performance measurement based on financial. We have discussed three techniques basically. One is ROI, residual income. Other one ROI, return on investment. Then economic value added. So all these concepts were discussed from different perspective. Return on investment, we discussed, it's a relative measurement. It has its own weaknesses and advantages. And also RI is just to improve the issues in the ROI. It has its own advantage, disadvantage. Then we look at the shareholder perspective. Shareholder perspective is shareholder value, and stakeholder value is the perspective. Now we will just very briefly will discuss the when you think performance measurement, what is essential is you need to motivate the people. So just mere performance system not enough. So thereby it is essential for you to have appropriate rewarding, motivation, encouragement, employee satisfaction methods to really comply with those performance measurement system. What I feel is now we are discussing reward system, processes, practices, system which are used to provide level of pay and benefits to employees. That means the reward system is basically benefits, maybe in terms of salary, rupees, in terms of other benefits. Motivation means the process that accounts for an individual intensity, direction, persistence, effort towards attaining goal. We are keeping the individual's intensity and the directions and persistence. Three things: intensity, direction, and persistence of efforts towards attaining goals. That's the motivation. That means we are really encouraging employees by themselves. We don't punish them. We don't closely monitor them, but we just themselves encourage to achieve goals. That's called the motivation. Then there are two types of motivation. Intrinsic motivation is really inside of the human body, inside of the people, derives from the interest and enjoyment of the person. So you feel it's very interesting, very nice, very enjoyable, the work environment. So we certain cases we may create the environment, office environment, much more attractive for employees to enjoy. Enjoy means not really dancing while working, but while working you just very very interesting and satisfied do it. That's the enjoyment. Extrinsic motivation means it's derived from sources outside the individual. For example, by giving salary, of course you can motivate people, etc. By giving promotion, by recognizing people's work performance, by appreciating employees' work, by encouraging them to motivate, by giving freedom, we can do the intrinsic motivation. But extrinsic motivation is physical objects. You are giving salaries, motor vehicle, a secretary, good room, appearance room, good chair, good table, attractive new furniture. All these are extrinsic motivation. Theories of motivation, there are different theories, but I don't think I will discuss all the theories in this presentation, but I think 2 or 3 theories are there. Just to understand theory of motivation, so Herzberg theory of work motivation. According to Herzberg, there are two factors. One is the hygiene factor, other one is the motivation factor. Hygiene factor provides the setting for encouraging employees' motivation due to do not themselves motivate employees. So, it provides the setting hygiene factor, appropriate environment, appropriate office environment. It provides the setting for encouraging employee motivation. We believe that they are not motivation themselves, so thereby we need to put a small push. That small push is the encouraging employees. Working conditions and wage levels, rules, regulation, relationship with the colleagues and job security, hierarchy. When you create a hierarchy, it's a hygiene factor. You have the boss, then there are certain regulations, what is expected, what is given, instruction given by the boss. All these are really working conditions, job security, etc. But motivators factors, so the motivation factors are really factors that relate to job content and which provide employee motivation. That is somewhat related to the work you perform. Whether the job is, routine, whether the job is diversity. Now, when you work in a bank counter, I think work is much more routine. It is true that you will meet different people. You can talk to diversity of people, but the work you carry out at the front line or as a credit officer, mostly, routine. Factors that relate to job content and which provide employees. But if you take a consultant, the consultant job is not really a routine. Job content will vary depending on the assignment to assignment, like auditor. So thereby, factors that relate to job content which provide employee motivation, achievements, recognition, nature of work, responsibility, opportunity for personal growth are motivation factors. So if you are in a bank grade 1 or whatever, you should be in a position to go to the grade 2, then grade 3, likewise. So there should be a career path for you to go to the top level of the organization. So that's a motivation factor. You may work hard. If you know that throughout my life, my position would be this, then you are not motivating. So thereby, achievements, recognition, nature of work, responsibility, all these are motivated factors. Hello? Motivators factors. Then theories of motivation. I hope that you can hear me. Right. Theories of motivation factors. We will go to this sharing again. Okay. Theories of motivation. Expectancy theory. Employees' motivation is a result of the strength of the relationship between expectancy and instrumentality and balance. There are three concepts in theories of motivation under expectation theory. So earlier we talked about the theories of motivation, Herzberg theory. Now we are discussing the theory of expectancy theory. So there are three concepts: expectancy, instrumentality, and balance. Expectancy, perception that effort will lead to certain performance. When you put certain effort, you will get certain performance. You will get certain outcome. So you know that if you work this way, you can finish the job. That is something, expectancy. Instrumentality is the perception that performance will lead to desired outcome. When you put certain efforts, you know that there is an outcome. But instrumentality is, you know that you will get the desired outcome. Balance is the attractiveness of the rewards. Three things. Expectancy, you put some effort, you know the result is there. Second one, even though result is there, you should ensure that. You should know that for the effort you will get the desired, expected results. That is instrumentality. Then the balance, the attractiveness of the rewards. Motivational theories need to be considered by the managers when they are designing performance evaluation rewards. So what they are trying is, if you are giving targets for your employees, if those targets are unachievable, I don't think that employees will motivate. Employees will really, work towards, because they know that it's very difficult target. You can't achieve it, but you can get the result, but not the expected results, not the target. So thereby, and also when you design the rewards, so you should understand that rewarding system should match consistent with the risk or the effort that they are going to put. If the reward is very small, effort is much more, then there is no match. That's why I think, in private sector and in public sector, they say that private sector employees are productive and public sector employees are not productive or efficient. The reason is that in public sector, whether you take additional risk or not, whether you work or not, you get the salary. But in certain private sector organizations, to get the salary and the bonus, they have to work hard, performance. So thereby, uh, just because of rewarding system is the difference. Otherwise, all the people from Sri Lanka, one same family, two members, one is working for public sector, one is working for private sector. How can you say that one is efficient, one is inefficient? Same background, same family. The problem here is the rewarding system. So the rewarding system is not recognize those who take additional risk, those who take work. So thereby, if you are rational, if you work in public sector, what is the logic? No work, no problem. That's the logic. Rational man. If you are not rational, you work more. That's why most of the cases in the private sector, from this perspective, from the rewarding and the motivation perspective, answer is that. Then the performance-related reward system, performance-related payment system, incentive compensation system, link employee rewards for achieving and exceeding some performance target. You give some performance targets. If this target is reached, you will be get this much of money or this much of benefits. That's the performance-related pay system. So you can introduce it as teamwork or the individual. In certain cases, for example, inland revenue, you get the rewarding system for the branch. So branch, they measure the branch performance, and according to they will get the allowances. Or in a factory, you might say there are different type of quality circle teams or groups. So group may get the target, then group work as a team, they will get the bonus. So the bonus for the group will be shared among the team members. On the other hand, you may have the individual incentives. You have to work this much of work today. So then you get the, right? Individual incentive plans. Individuals are rewarded for achieving individual performance targets. This is the individual performance related. Subjective criteria may also be used, common at the senior level of the organization. This can be applicable for senior levels, but when you go to down operational level, operating employees, it is better to introduce teamwork, because division of labor is there. When you have the division of labor, it is always better to consider one complete task as one. So thereby, it is better to have teamwork or the group rewarding method. Performance related profit sharing plan. Cash bonuses are paid to each employee based on specific percentage of company profit. Does not tie individual efforts to individual rewards. Okay. Employees share plan. This is profit share plan. Provide employees with the right to purchase shares in their company and a specific price at a specified future time. Commonly used for senior managers, sometimes more junior manager employees, considered encourage goal congruence. So you may give a target, okay? If you achieve this year profit of 1 million or 1 billion, 10 trillion, whatever, we will give you, 10 shares. We will give you 10% of profit you earn as shares. So thereby, likewise, when you make more and more profit, you will get more and more shares. So this is, of course, basically for senior managers. Sometimes you get employees also, but this will ensure the goal congruence. Because when you are offering shares, when you are giving equity, when you are giving the ownership of the company to the employees, they are really working towards the group direction, thereby goal congruence. What is the meaning of goal congruence? Goal congruence means all the employees, all the divisions, all the teams, all the units, all the departments are working towards one direction, that is group strategic direction. If all are working towards one direction, that's called goal congruence. So if you introduce employee share plans like giving shares, offering shares, I hope that goal congruence will encourage. Performance related reward system, gain sharing, cash bonuses are distributed to employees when the performance of the company, their segment for the company exceeds some performance targets, gain sharing. So you give certain bonuses for a particular segment, particular division group. If you exceed this profit, your division will get so much. If you exceed this much, your division will get so much. So likewise, team-based incentive schemes, individuals are rewarded based on their work team exceeding certain performance target. Intend to encourage teamwork and cooperation between employees, does not tie individual effort to individual rewards. This is team efforts. Team efforts mean, when you say team efforts, certain employees can really be idle. That is the disadvantage. So thereby effort of the individual and effort of the rewards are not equal. But when you get the individual rewards, you put the effort, you get the reward. Group versus individual performance, consider the following issues: identification with the group, equity among employees, competitiveness between employees, relating individual efforts to reward, rewarding only good performance. So when you look identification with the group, difficult. Equity among the employees, competitiveness between employees. If you are giving individual, I think there will be compare related to individual efforts, rewards, and rewarding only good performance. The timing incentive payment can be crucial to achieve desired outcome. Timing incentives. More frequent rewards may help ensure continuing motivation. So I think that's all about the slides. The summary is there. Of course, you can read this summary. So what we did was here, we calculate the, I think we did discuss the break-even analysis also part, and also we discussed certain part about calculating break-even point, rupee wise, then the multiple product, graph, assumptions, fixed cost, variable cost, contribution margin, contribution sales ratio, margin of safety, then of course target profit for tax, without tax, all this stuff we discuss. And under performance measurements, we discuss three techniques basically. One is return on investment, residual income, and economic added value. But we discussed the shareholder value from the DCFT technique perspective. Then we discussed the reward system. We discussed two theories very simply. Motivation theories, that is the Herzberg theory, two-factor theory, and also the expectancy theory. Then we discuss the reward system, different type of reward system. We discuss individual and the group, profit-based sharing, shares giving, teamwork, etc. And discuss the advantages also about these two rewards and the group rewards and the individual rewards. I think with this, this session is over. So since we have a little time, if you have any question, you can put those questions into the box, then I can answer if you want. Otherwise, lecture is over. I will give you 5 minutes. If you need any question, if you have any question, just put, I will help. Whatever the question, you can ask if you have the mic. Otherwise, you can put any question? Okay, I will ask one question. So, right, can you please send the answer for the past paper? So answers for the past paper will be discussed. I don't send any answers, but I will be discussing the one past paper or two past paper at the end when I'm revising. Can we get some questions related to this topic? Yes, I will send you questions if you want. Yes, no problem. I will ask. I will give it. I will send it to. But past papers, of course, having question. But I can give you two questions. I will prepare it. I will send it to next week. Of course, reference book is you can use the Colin Dury. Colin Dury for this CVP and CVP and performance. Colin Dury. Maybe Texas cost and management accounting. Other topics, any finance book. Any finance book. Teratex. Any finance book. So what is mean by CS ratio? It is used to calculate. Yes, CS ratio is used to calculate the break-even. CS ratio is basically contribution, that is selling price minus unit variable cost is the contribution. That is the contribution. Selling price minus unit contribution. So then contribution is the C. When you divide the contribution C by the selling price multiplied by 100, you get the CS ratio. CS ratio means when you sell one unit, what is the contribution? Say you are selling one bread or one coconut, king coconut. So if you are selling, suppose at 100, if you purchase it by 40, contribution is 60 rupees. So 60 divided by 100, CS ratio is 60%. But your fixed cost is not included in this calculation. That's the idea. How do you calculate the down payment? Is really the amount finance. You calculate down payment amount finance. This is not under reducing balance method. This is under annuity method. Reducing balance method is a little different. Amount finance, it can deep unaya bedanama. Present value, interest factor, annuity. Okay. Amount finance, you just divide by the present value, interest factor, annuity. If it is say 5 years loan, 5 years factor. If it is 10% interest per annum, 10%. Okay. If it is 5-year loan, 10%, that is how you have to. I think present value interest factor annuity table is number 4 table. The formula you can remember. Amount finance can deepu naya pramane bedanama present value interest factor annuity. Make a leasing ekak na. If it is a leasing, so you get the installment in advance. So then of course you have to multiply it by 1 plus megane nam warahan ekadana I කියන්නේ 10යි. Okay, very good. So making වැඩි කරාම lease rental එක. Lease rental is an annuity due. A loan down payment is annuity general. ඒකට දෙකක් එක. මේ තියෙන දැන් annuity amount finance present value interest factor annuity 5 years 10% multiplied by 1 plus R ගත්තේ එතකොට 10ක් නිසා 1.1යි එකෙන් වැඩි කරා. If that is the case, right? So CS ratio, of course, we can use to calculate the break-even. Fixed cost divided by CS ratio, you get the break-even value. So what is meant by CS ratio, Hari? The related this relates to question: how can we calculate down payment? Right. Yes, down payment is that way. Any more question? Time value of money. Time value of money, of course, you may refer finance book. You might have different finance book and one book may be Fundamental of Corporate Finance, Stephen A. Rose. Again, Rose කියලා. එතකොට මේකේ ෆෝමියුලා එක මම දානවා අර ඩවුන් පේමන්ට් එක ගන්න එක ඔය විදිහට ගණනය කරලා 1 + i වලින් වැඩි කරේ ෆිනෑන්ස් එක මේක ගන්න. අරකට එන්නේ මට මේකේ ස්පෙලිං පොඩ්ඩක් අමාරුයි ස්ටෙපන් නේ ස්ටෙපෙන් අපි කියන්නේ රෝස් के පොත ROSS name is Fundamental of Corporate Finance. Fundamental of Corporate Finance. It's a good book, but there are Indian texts also. You can use the different editions are there, but don't worry about the edition. No need of taking the latest edition because corporate time value money stories always no changing. That's all. Then shall we, any question, any further question? I hope that you will submit the assignment. I gave you very easy one, simple one, but I hope that what is APR? APR. Where? How do you get this APR? Just tell me from where. It's annual percent. Yeah, it says annual percentage return. Yes, it was in the annual APR. Yeah, because APR means there are different abbreviations. That's why I asked. APR is in time value of money, of course, annual percentage return. So what do you mean? What do you want me to? What is APR? 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 If you tell me very clearly, I will tell what it is. APR. Because application is different. Since there is a time, can we discuss the question from vast paper for the subject completed? What is the difference with compound rate? What is the difference with compound rate? You are asking very difficult question. Difficult to answer. What is the difference with? You mean APR and compound rate? Compound rate and yes, compound rate and APR. Yes. No. Huh? Arakan. Untaken. Charger. APR, ninth question of the assignment. Ninth question of the assignment. Wait, I'll look at. Because it gives different meaning. Look at the whole Pokemon. APR 9 question. Submit. That was budgeting, capital budgeting, previous financial assignment. I don't have the question with me. But anyway, my contact number is not 7144639447. You may contact me. My email is ananda27 at SJP. I'm working for the University of Sri Jayawardhanapura. SJP at .ac.lk and on the Visyartha sjp.lk. If you finance the purchase a valuable tool toy for your kids, rupees 500, 20% APR compounded monthly for 2 years. How much is the monthly? Right. Simple. Now here the question is, if you finance the purchase of a valuable toy for your kids, 525, 2 years. අපි ණයට ගන්න 525ක්. ඒකනේ මේ කියන්නේ නේ. රුපියල් 525ක් ණයට ගන්න. අපි අහනවා monthly payment එක. Now there are 2 years, but monthly compounded. Monthly compounded means you calculate the interest monthly.
24 months.
Thereby, here the interest rate given in annual percentage return, APR, not the effective interest rate, annual percentage return. So thereby you divide it by 12. You get the monthly rate. Then you apply the rate to the present value interest factor annuity formula. Find out the factor. 500 divide by 525 divide by the present value interest factor annuity. That's all. You get the answer. But here you have to remember 20 divided by 12, you won't get the exact complete figure. So thereby you should know the formula. Formula eකට දාන්න. Is it clear? එහෙනම් නැත්නම් ටේබල් එක හදා ගන්න ඕනේ රේට් එකේ එක කොලම් එකකට. 1.0 මම හිතන්නේ 12 20 බෙදුවාම එනවනේ 1.0 ගාණක්. නේද? 1.8 ගාණක් වගේ එනවා. ආසන්න වශයෙන් 1.8 ගාණක්. That's the answer. We will discuss the question not today. I don't have those question papers. I have, but I can't remember the password and all that. It's difficult to open. Any question? That's good. Since there is a question, okay, I have answered that. Annual percentage. Very good. I will give you a question. So can you calculate this answer? Right? There are two products, product A and B. There are two products. Okay? And the mix is say 20% from A, 40% from A, 40% from A, and 50% from the product, 60% from product B. Okay, product A and B, 40% and 60%. From product A, you are selling 40%. From product B, you are selling 60%. That is called the product mix, what we discussed in the earlier question. Product mix. If that is the case, suppose selling price of A is 100 rupees and variable cost is 20 rupees. That is the selling price and the variable cost. Product B, selling price is again 50 rupees and variable cost is 25 rupees. Okay. right? So I gave you three information: product mix, selling price variable product A, selling price variable product B, and fixed cost is say 500,000. Can you calculate the BEP? You got my point? Product A and B. So thereby you see that since there are two products which is coming under the today what we discuss product mix. So calculate the contribution of each product. What is the contribution of A? Contribution of A is 80 rupees. How? 100 minus 20. Contribution of product B is 25. Okay. Then you calculate the weighted average of contribution. How do you calculate the weighted average? 80 क्या गणोद?
40%.
From product 1 you are getting exactly 80% you get 80%, sorry 40%.
40%.
Then plus 40%. From product B you get your contribution is 25 and you get 60% because that's the mix. So you get the average contribution. This is called weighted average contribution. How do you get it? You calculate the product 1 contribution, apply the mix rate. You calculate the product 2 contribution, apply the mix. If there is a product 3, same thing. You calculate the contribution, apply the mix. Always mix is equal to 1. Here now 40%, 60% plus 100%. If there is another product, you get another ratio. So which is equal to 1 always. So thereby, that is how you calculate the weighted average. I think you can remember, we calculate the weighted average cost of capital, same thing applicable. එතකොට මං හිතන්නේ මෙතනින් එනවා 16ක් නේද? අතන 160ක් කියන්නේ 4 30යි 6 2 12යි 15ක්. මං හිතනවා මං හරි කියලා. 15ක්. ඒ උත්තරේ එනවා 31ක්. ඉතින් අපි BP ගණනය කරන්නේ කොහොමද? BP ගණනය කරන්නේ කොහොමද? You just 500,000 අපේ 500,000 මෙච්චරයි අපි බෙදනවා ඒක 31. That is the BEP. But now BEP is in a common term package. BEP as a package now. So what is the quantity of BEP from A? What is the quantity of BEP from B is the question. එතකොට කරන්න තියෙන්නේ මෙන්න මේ උත්තරේ 5 ලක්ෂ බෙදීම 31 multiply කරනවා 140. එතකොට නෝ A වලින් ගන්න ඕන BEP කරානේ. අටවර 4 32. Yes you are correct. මම දාලා දෙන්නේ කියලා 16 32. Yes you are correct. I do agree. එතකොට උත්තරේ එන්න ඕන 32යි 15යි 7යි 47යි නේ. 47 බෙදන්න ඕන. ඒ කියන්නේ sorry 5 ලක්ෂ බෙදන්න 47න් වැඩි කරන්න ඕන 140. නේද? එතන A වලින් කරන්න A වලින් විකුණන්න ඕන ප්‍රමාණය B වලට B break even point වලට. So 500,000 divided by 47 into really 60%. is the break even from product B? That's the answer. Is it clear? So that is how product mix is calculated. Now, with its ratios, don't ultimately when there is a ratio, you can develop a very good paragraph. But when you apply the data to the formula, you may find out 5 or 6 variable, maybe 3 variable. So thereby always from the paragraph, from the lengthy scenario, we are trying to find out relevant variables. Maybe same variable might have given in segments. Variable number 1, variable number 2, variable number 3. So for the formula, when we apply, we have to add all these variables. I think with that, shall we conclude? Any question if you want, I can answer. But you may contact me over the email or phone. But sometimes I may not answer the phone. But better you take if you are taking me a call, call me. Better take after 8. Then shall I wind up for today's session? Okay. Then thank you.